Welcome everybody. Thank you for being with us today. My name is Jocelyn Lajara and I am a product manager for the analytics department. And today I have the pleasure to introduce these two gentlemen that will talk to you today about interoperability, social inflation, and supply chain, and basically what are we doing to tackle those critical challenges in our industry. So just some housekeeping items, of course, as always, you've seen this slide about 1,000 times now, but I have to say it. This is just a slide saying that whatever we're going to discuss today is not a contract between you, the customer, and us as Guidewire to build any products. It's just a conversation about vision and what we're trying to do here. So our speakers today will be Ian Bird. He's in the Solution Advisory team for EMEA, and Luis Guignard, who is a Director of Data Science for Guidewire. So with that, I'll hand it over to you.
Thank you. I'd better take this. Yeah, I don't need the mic, but I definitely need this. So yeah, thank you ever so much, Joss. So Lewis and I, we're going to take you through a few pieces. Both Lewis and I are going to talk a little bit about interoperability. I'm the warm-up act for Lewis. So I'm going to give you a bit of a plotted history of that, and Lewis is going to bring it round to what we think about in terms of some of the things we're doing with Guidewire. And then social inflation. Maybe some of you were at the talk last year when we talked about that, but we'll find out as we go through that. And then Lewis is going to cover off with some supply chain at the end there. So let's get into this. All right, so interoperability, as I say, I am the warm-up for Lewis. I'm going to take us way, way back, right? So the thoughts about data and analytics and how we use that, it's said that even the Egyptians used statistics to build the pyramids. And I guess, given their longevity and the fact that they were a pretty awesome structure, you'd imagine that they didn't just make it up, right? They didn't just turn up with some big boulders and go, let's see what happens. But the thing I want to bring it to, as somebody from England, is the Doomsday Book, because this is where the problem all began when it comes to interoperability, right? So this was the great survey of a lot of England and parts of Wales that William the Conqueror basically said that we should do this, go around all of the different landowners and effectively collect information about the assets that they owned. So this is labor force, this is the number of goats, whether they have a plow, that kind of thing. And they pull this all together in one big manuscript. And it kind of looks like that. I'm bound to have to use licensed images, so the real Doomsday Book is definitely a lot more yellow than that, but you get the idea. Okay, so effectively, the big problem that we had with the Doomsday Book is, do you know that there are big blank areas of that manuscript? And those blank areas cover the City of London and the City of Winchester. Winchester being where the royal court was held, right? So you've got to ask yourself the question, where is that data, right? It's missing. And already you start to see the problems with interacting with different data sources to be able to gain useful analytics, or in this particular case, gather some taxation. And can anybody imagine what it was like doing a write outer join or a union all in Latin rather than SQL? Probably pretty difficult, right? I see there's literally no database people laughing. Okay, fine. Or maybe there's no database people in here at all. So we step forward nearly a millennia, right, to 1948. Does anybody know what this is? It's not a television. It's actually the baby, it's called, and it's the Universities of Manchester's first computer. And it was the first computer to execute a program stored in addressable read-write memory. Pretty cool, huh? And that particular thing, I know there's been the Harvard computer before that, but this was the framework that effectively gave the evolution of computing technology as we know it today, right? So a really cool piece of kit. If you're ever in Manchester, go and see it. We only have to go a generation on, and we have people like Seymour Cray, who would have been crying at the length of some of those cables, I tell you. But he was building supercomputers. We were building mainframes. In the 1970s, we started to see the advent, thanks to Mr. Codd, of the relational database, right? The ability for us to store structured information in a way that we could query and get information from. We do know that RDBMSs were not designed to cover unstructured data, but as generations have gone on, we've learned how to pool these pieces of data together, we think. There's a big problem, though, with anything that's data. I'm going to use this very, very simple example. You know, my name, Ian Bird, has got exactly 7 letters in it. Do you know how often people get my name wrong? It's incredible, right? I don't get insulted by it. I've become used to the fact that people interchange the vowels quite happily. But we often see in data, the ability for us to put 2 people together is fraught with issues. So on the left here and on the right, we've got 1947 versus 1974. Is that a date transposition error, a keying error? It's Ian Ben or Ian Ben spelt Gallically. The question is this father and son? Is it the same person? And we actually start to need to fuse more data in that to actually make us build hierarchies of data to determine which is the one that's going to win out. So if Mr. Ian Ben on the left is from a credit card system or a bank account system or for the mortgage, there's a good likelihood that that's going to live higher up in that data hierarchy than something that's a sort of sidewalk-based survey where we're getting information from people that walk on by. But it demonstrates the kind of basic problem of even bringing something together for a single customer view or the single version of the truth. And you can see here that literally no expense was spent on this slide. But it gives you the idea of what we all see in our organizations, and it's not just insurance. We have multiple source systems. We have COBOL mainframes. We've got spreadsheets. We've got databases that sit there, all of which are giving us information about products or people. And we have tried over the many, many years to pool that information into things like data lakes or enterprise data warehouses to be used by a variety of different audiences. So on the right-hand side, you might have sales and marketing, the voice of the customer, accounts and finance and credit risk, and needing it for regulatory purposes. And this very, very simple diagram is a way of demonstrating that these silos that we have, no matter how we attempt to build those, can create silos on the other side, as those different audiences are trying to find their route to get their right information at the right place in the right time, but they end up building additional systems around that to make them appropriate for their particular needs. So Lewis, I'm going to hand over to you now to take this into our insurance world a little. Thank you.
That's great. Thank you, Ian. So like you said, let's bring that into our domain just a little bit. Who are we? We are the insurance community. We could be brokers, reinsurance brokers, insurers, reinsurers. We're oftentimes insured as well. Hopefully you are. This is the basic ecosystem we live and breathe in our professional lives. Outside, we've got third-party data sources, regulators, insurtechs. There's only 3 basic types of information in this whole industry. There's what you're insuring. Is that a person, a location? There's how you're insuring it, the shape of the policy. And if a claim occurs, there's the shape of the claim. So how do we share these 3 basic data types amongst each other in this community? I don't know if any of you have heard of Microsoft Excel, but it's an amazing piece of software to help you share data between any participant in the insurance ecosystem. I'm not being sponsored by Microsoft, I should mention that. It's a great tool. It's a great tool for actuaries, a great tool in general. It causes lots of friction in our industry. I'm sure you're all very well aware of that. We've had some stabs at standardization, right? We have Accord forms, we have the OASIS open source standardization format, and we have databases, lots of other technology like others, but largely there is a lot of manual coding to get information out of one system and into another. And that's when we say interoperability or the lack thereof, that's what we're picking on our own industry for, is how hard it is to push information around. So let's make a quick example of a reinsurance use case. So I'm a reinsurer. I like to have bordereaux for my cedants or insurers so I can understand what risks they're trying to offset onto me. But every insurer encodes their policies in a slightly different way. So I end up with a rainbow of different formats of information that I now have to try and merge into one format. So over on the right, in my reinsurer's data lake, I end up with all sorts of formats of information that's really the same data, just encoded with different names. This makes it very hard to answer questions like, how many times am I insuring Coca-Cola across all my cedants? It's very difficult. Usually the process is an insurer or a broker acting on their behalf is going to email me some bordereau in a spreadsheet format, and then it's on me or maybe the reinsurance broker takes some of that effort to shape that into a bordereau that my systems can understand. This usually means that analytical teams in the reinsurance industry are spending 30 to 45% of their time editing spreadsheets. And it would behoove one to ask, like, is that what their undergraduate and graduate degrees train them for, or was it higher order, higher value work? Well, this has been solved in software in general already, right? So instead of manually encoding these documents every time they come in software, we now use what we call APIs, application programming interfaces. They have mouths and they have ears. In developer land, we call those GET and POST requests. So these applications speak slightly different languages, and that's what a developer usually does, is they come in and they write an integration once to connect to APIs, to connect to systems, and thereafter, until there are updates and breaking changes, those two APIs can communicate, and these two systems are now in sync, so to speak. So, what can we do about it? How can we improve our industry? And I'd be remiss as a data scientist if I couldn't find a way to weave generative AI into this talk. So how can generative AI help with this task? Well, it's actually one of the projects my group has been working on, is trying to ease the interoperability friction with the large language model. So like I said, we're usually talking about what's being insured, how are you insuring it, and if there's a claim, what went wrong. Right? A lot of these things are types of data that language models can understand and can transform from one system to another. So in the case I mentioned earlier, maybe you're a reinsurer who has a specific format of bordereau you like to use, and now there's an insurer over in Policy Center who would like to extract their information and send it over for a quote. Well, Rosetta is a tool that could help automate their transformation process and ease the friction of interoperability. Well, their demo we'll have in an hour down at the AWS demo booth will be SOV ingestion into Policy Center. These are just some of the ways that we're looking to help ease the friction in the interoperability space, because we believe that's where some of the biggest gains to your bottom line as an insurer can come from, through dropping that expense ratio. With that, I shall pass it back to Ian.
Thank you, Lewis. Yeah, definitely check out the demo. What time is it, Lewis?
Good question. 4:45.
Cool. All right. So social inflation, hands up, who knows about social inflation? Okay, I can't see from the lights, but I think there's 2 or 3 hands. Would anybody like to learn about social inflation? Because you're not going to. No, you are really. So I can certainly tell you that social inflation, no, it is not. Sadly not. You can see here that this gentleman is definitely plunging to his death, though, right? So shortly after this photograph was taken, there was less fun to be had at that pool party. But no, social inflation, in a nutshell, describes how insurers' claims costs are increasing above and beyond general economic inflation. We all know the challenges that economic inflation is giving us already, okay? Now, as Guidewire, we've been thinking about this for a good couple of years now, and we've actually got a white paper out there. So we know that social inflation is fairly ill-defined, but it's certainly something that execs think about. It's something that execs muse over. In our white paper, we attempt to define it, as we've described there. We give a good definition around this problem space, and we give you some useful insights into those increases in claims costs above and beyond that economic inflation. So we'll dig into that a little bit in terms of the litigious practices that are now in place that allow claims to explode out from what you might consider them to be. Okay. So thinking about the risk landscape, well, surely as insurers, we've got a hold of this. What's the big problem? Why is it different? We know about things like wage inflation. We know about price inflation and medical cost inflation. But you need to ask yourself the question, is the trend historical and is the trend stable? And if it is, that means that our actuaries can actually price the risk, right? And make it better for us. But if it's not historical and it's not stable, how do we account for that? How do we think about that? We need to start thinking about other routes and other data, but let's talk about what's driving this problem. So emerging risks is not really social inflation, but let's at least think about what happened in the 1980s, when we found that certain medical policies didn't cover something that was unforeseen at the time, right? So there was no history of that. And so therefore we'd priced for something that was ultimately claimed against and we weren't ready. It caused a problem with liquidity in the industry. But with social inflation, what we're seeing is that there are new legal theories. So in other words, attorneys are out there looking at potential legislative frameworks that they can use against wordings, et cetera, to actually force a litigious claim into that. We've got these new litigation practices where we're actually seeing law firms using things like social media to promote their services, especially if they find that there is a way where they have found they get results, right? And when they do that, they can post out there and advertise and target to find other audiences who may have had similar claims that could force litigation into that. And then we've got things like the jury bias, the little guy versus the big corporate, okay? I heard a great story yesterday. Apparently one of America's largest law firms has just employed a screenwriter from the program Law and Order to write closing statements for their attorneys. So can you imagine the drama, the way that they're going to be setting the scene, the way that they're going to be playing this off so that the jurors are like giving in to the plaintiff? Well, that's what they're doing, and it's happening. And then we have this increased attorney ad spends. I recently drove from New York to Philadelphia, and the number of billboards that were displaying attorney practices, attorney practices, attorney practices, and then maybe the odd one for Mountain Dew or something, but it was mainly that. And then you take that to the next level on social media. I hate to think what your feeds are like when you're going through Facebook, seeing all of these different pieces. So we've talked a little bit about these underlying factors, the anti-corporate bias that grew out of the sort of 2008 financial crisis, the big corps versus the little guy. The demographic shifts, and I think this awareness, or heightened awareness of social injustices that again can be propagated out through social media. It doesn't take much for something to go viral, and that's why the multiplier of being this sort of technological advance in this area really helps accelerate that. And then we have got this aggressive plaintiff attorney practices feeding into this idea of no win, no fee. So the expansion of this third-party litigation funding. So this is where law firms are standing up capital to go and fight your litigation battles for you without you paying a penny. And that means that there's a stronger likelihood that you may seek litigation or additional above and beyond the claim if you don't have to pay for it. Now, the trouble with this is when you get these nuclear verdicts, you end up with a considerable amount of that settlement going to the attorney firms. And it's not basis points, it's tens of percentage points. And the claimant themselves, they'll get something out of it, but not all of it. But the point is, the fact that they have that no win, no fee mentality at the beginning means that what have you got to lose? Absolutely nothing, okay? Can we track it? Well, definitely there's more and more data becoming available. And I'm going to pick on, I am going to pick on Florida. There we go. Sorry, Florida. But there's an interesting article, or I think it's a blog post, by the Insurance Information Institute that came out maybe about a year ago. And it's quite insightful in terms of Floridian insurance. We know that there is an increasing protection gap in that state. We know that there have been several insurers that have gone out of business that were supporting Floridian properties. But what's been driving this? Well, this is actually nothing to do with what you might think it is. Hurricane, no. It's fraud and litigation that's driving that. So new roof claims, you don't need a new roof, but you're going to have one anyway. But then the litigation is really interesting. So even though Florida makes up 9% of claims nationwide, it's actually responsible for 79% of claims that go to litigation. And it means that it's driving premiums from around $4.5K on average in Florida, which compared to sort of $1.5K nationwide, it's a 3x differential. And the insurer of last resort in Florida has seen the number of households that are seeking their insurance grow from something like 400-odd thousand in October 2019 to 900-odd thousand in the month of October 2022. And you can only imagine that that's going to be into the million mark per month by now, right? As that trend continues. So quite an interesting piece there on Florida and how social inflation is driving that litigation a little bit. But what can we as Guidewire do about that? So we've just recently worked with an insurer specifically on Florida homeowners. And we're looking at this propensity for a claim to go to litigation. And we actually interact with Claims Center to make sure that we inject some insights into that claims process to help the insurer get ahead of the potential for that litigation and do all of the right reservings and those kind of pieces. And the model we've built for that is some of it on non-obvious data. You've heard Mike and plenty of other people this couple of days talk about Hazard Hub, so we've got a good wealth of information about the property characteristics. But we bring in things like the key aspects of the claim, the things like the property, the region of the property density around that. All of these are different factors that we can look at. And the lift we've got is significant, right? It's not like a 2x lift. It's several orders of magnitude in terms of lift. And so that gives loss adjusters the ability to view the potential for something to go to litigation. And it follows that this type of capability is not going to be relevant for just Florida, because if those attorney practices spread to other states, we could see similar outcomes in those areas as well. So one way of us getting a little bit ahead of the curve. Anyway, that's enough from me on social inflation. I hope it gave you a little whistle-stop tour on what we think about it, what we can do about it. And I'll finally hand back to Lewis to talk to us about supply chain. Thank you ever so much for listening.
All right, thank you, Ian.
I guess that's mine.
That's yours, definitely. Okay, so, excuse me, interoperability, social inflation, now supply chain. Supply chain, top 5 risk to executives, according to survey in 2022. Next up was cyber. Cyber was pretty hot, and then COVID happened and all the inflationary crisis and supply chain disruptions that we had. So this is the new state. What are executives concerned about? But isn't inflation mainly a supply chain disruption as well? Well, that puts supply chain up well over 40% of concern by respondent, right? I will admit inflation was partially caused by the economic injections into at least the US economy. Demand was up and supply was down. But still, it's a big concern, right? We're getting a little better, but we all know there's globalization. Some argue de-globalization is trending now. Supply chain's a big concern. So what are we doing about it in insurance today? Well, not a lot, at least not directly. Supply chain's covered indirectly through several different lines of business. You've got BI and contingent business interruption over in property. That's probably some of the oldest ways we've covered supply chain, but most of those cover physical damage. And for the contingent business interruption, usually those are bespoke additions to a policy for individually lined out suppliers of critical need to a specific company. Marine and cargo cover products in transit, which is good, but there's not a lot of overlap between that and the property. And then for one of the newer ones on the market, something I've been involved with at the beginning of my insurance career over in the cyber domain, you have analogous business interruption and contingent business interruption coverages there. So supply chain is covered in little bits and pieces from different underwriters under different lines of business. Well, if this is such a huge concern to the markets we serve, to the insureds, how do we get to this point where we're not actually servicing them and allowing them to easily transfer this risk should they feel the need? Well, part of that's history, right? So supply chains coverages through properties. Property is one of the oldest lines of business in insurance. And it's one of the cleanest ones to sort of underwrite. Like you understand business interruption. I think Chris Folkman had a great slide about the Gaylord Hotel. What that looks like, it's easy to count up the rooms. Modeling the causes of BI are quite hard, but that's the history. Further, it's opaque. Like I said, it's hard to model the likelihood of flood against this building. Well, how many other ways could you disrupt this building? There are a lot of geopolitical risks, you might say, a lot of folks in this building. Many ways to disrupt the supply chain, which probably makes the underwriter cringe, right? If they can't get a handle on the risk, why would they want to underwrite it? And third, just like I was showing in the previous slide, there's largely a lack of communication and knowledge sharing in insurance about supply chain because it's covered in so many different lines of business. Like how often do you get the cyber folks and the property folks and the marine folks all in the same room to compare notes on these different views of risk, right? So we're just a little bit disjoint in this domain. I'd mentioned I'm really into cyber. I've worked on a lot of cyber cat models, been in cyber insurance. I'm a little more of a generalist now. But I thought I would take this opportunity to use physical supply chain as an analogy for digital to show that it's not that complex and opaque if you think about it. So in physical, you have to move things. That's what these arrows are, things moving from one place to the other. You do those with ships, boats, Amazon trucks, drones one day, apparently, a little terrifying. Over in digital, how do you move information? Through the internet. There's a physical cable at some point, or a Wi-Fi router at some point, but the internet is the abstraction. When we say cloud, it's that abstract surface over which information flows. Again, in physical, you start with materials you dragged out of the earth and started melting them and shaping them into higher order, more complex products, so you end up with an iPhone. Those actions are taken in a factory. That's where you take materials, combine them, manipulate them to make higher order materials. Over in digital, that's done with software. You take lower level information, maybe it's a recording of this talk, and then you pass it to software, which can turn the audio track into text, but it manipulates information. And then finally, beyond the shipment and the manipulation of goods and services and digital, you have the consumption. So I like to think of it as last mile delivery, is getting your physical goods to your house. That is the Amazon truck or the drone. Over in the digital world, that's some sort of user interface, and it's a very trendy topic of research lately, but that's finally getting that information into someone's brain where they can use it to make a decision. So all this to say that digital isn't that different from physical if you pitch it to the right analogy. And it's not that different of a risk. It's not orthogonal. So for an example, let's take the Kaseya managed service provider incident of July 2nd, 2021. So Kaseya helps companies who don't want to manage their own IT. They come in and manage it for them, right? So Kaseya happened to give network infrastructure management to another company called Visma. It was a financial software engine, who in turn handled point of sale systems and other systems for a Swedish grocer called Co-op. Kaseya got hit with a ransomware attack, which knocked out its systems, which knocked out Visma, and it trickled down into this Co-op, this grocery store in Sweden. So they couldn't make sales, so even though they had food, they had to close 800 stores. And in some locations in Sweden, there's not a lot of grocery stores, so people couldn't get food. So this is a physical disruption from a digital cause. All that to say that maybe the underwriters should be talking to each other across these perils that aren't actually so different. So I've been complaining a lot about how we as the insurance community have approached this problem or not. I'd be remiss if I didn't come up with a strategy or an approach. So how do we address some of this disjoint state that we're in? First and foremost, I think, is collaboration. Get these underwriters who have looked at this problem from different viewpoints with different concerns into the same room. Like have periodic workshops and think about what are the risks, what are the entrants, how do these things overlap with each other? How does an event in marine trigger a BI incident in property? So get some knowledge sharing going. Next, data and modeling. Again, I'm a data scientist, so love to plug data. You've got digital twins that help map, factory operations. We have similar logging technology over in the digital domain to know how things are going. You can take 10K filings to find out who are the suppliers of the organizations you're considering to underwrite. We package all that up in a graphical database for a supply chain risk model, but you need somewhere to merge all that data into a central source Once you have that source, you can start educating each other and taking a more holistic review of the supply chain peril. You can look at the policies you have, discover where there are gaps, where there are opportunities, and you can perform scenario testing and CAT testing like we do in property, again, going back to the Florida example. All that education and all that testing is supposed to build intuition, understanding, and ultimately comfort with supply chain as a risk to service those executives I mentioned at the beginning who need it so badly. Once we feel good about this as a risk, we can start thinking about more holistic supply chain coverages with applicable sublimits and exclusions where we feel we would not want to transfer the risk for the edge cases. So I realize, I think that's the last slide, and we're still a few minutes early, but I would love to invite Ian back up and open up for questions on interoperability, social inflation, or supply chain.
Or anything else.
Or anything else. Favorite ice cream?
Or not. Tough crowd.
It's a tough crowd. If your hand's raised, we're quite blinded up here, so.
All right. We'll let the pressure off then. Thank you ever so much for listening.
Thank you, everyone.
Have a good day.